Stop scrolling. Silver just ripped through $32 overnight. Levels that held like concrete for 3 years. Gone. But here's what the charts won't tell you. I tried buying physical yesterday, 4 dealers, all quoting 15 to 20% premiums over spot. One actually laughed when I asked about bulk orders. Come back in 2 weeks, he said. This isn't another metals pump. When price breaks resistance while physical availability chokes, that's not speculation. That's stress fracturing through the system. If you're holding, stacking, or even just watching silver right now, your risk map just shifted, hard. If you're seeing this before the weekend headlines hit, you're already ahead of 95% of the market. Your job isn't to predict, it's to understand what these signals actually mean before everyone else panics. I'm showing you 2 patterns that repeat every single cycle. Miss them, and you chase. Understand them, and you position. Before we go further, subscribe. Not for me, for you. These patterns save portfolios and drop your location and the premium you're seeing locally. We're building a real-time map of physical stress. Community data beats Bloomberg terminals every time. Here's what just happened. Silver punched through multi-year resistance at 3180, accelerated past 3250, and kept running. Gold barely moved, sitting around 2650. The ratio compressed from 82 to 78 in 2 sessions. Fast money? No. Check the commitment of traders report. Specs actually reduced longs last week. This rally isn't leverage, it's rotation. Real money rotating from bonds to metals, from gold to silver, from paper to physical. But the signal almost everyone is missing is lease rates. 1-month silver lease rates jumped from 0.5% to 2.8% in 5 days. That's not normal. That's institutional borrowing costs exploding because physical metal is getting harder to source. When banks pay 5 times normal rates just to borrow silver, something is breaking. Think of it like a fire hose. Water pressure stays constant, but someone slowly closes the nozzle. What happens? The stream gets more violent, more unpredictable. Eventually something gives. That's silver right now. The valve is physical availability. The pressure is demand. Price is just the gauge on the side. It moves last. Here's how this actually works in real markets. Registered silver on COMEX, the metal that's actually available for delivery, dropped 18% in 2 weeks, from 42 million ounces down to 34. Eligible silver, the stuff sitting in warehouses but not for sale, increased. Let that sink in. Metal is moving from available to held. The valve is tightening. Shanghai premiums hit $1.20 over London yesterday. Normal is 20 cents. When Shanghai pays 6 times normal premiums to pull physical silver out of London vaults, that's the valve squeeze in action. Price hasn't even caught up yet. This pattern repeats because it's structural. Late cycle stress always shows up in the plumbing first. Always. 2011, same pattern. 2020, same pattern. Premiums widen, lease rates spike, warehouse classifications shift, and then price explodes. Watch the valve, not the gauge. And right now, the valve is screaming. Now let's talk about the second pattern, the rotation ladder. Institutions don't wake up one morning and decide to buy silver. They climb a ladder. First rung, treasury stress, yields spike, or credit spreads blow out. Money moves into gold. Second rung, gold gets crowded, ratios stretch, mandates force rebalancing. Third rung, silver, the multiplier, the catch-up trade. We're between rung 2 and rung 3 right now. Gold hit records 2 weeks ago. Every pension fund with a 5% precious metals allocation suddenly found itself overweight gold. They can't sell gold without fighting the trend, so what do? They buy silver to rebalance. This isn't about silver being cheap. It's portfolio math. Here's the tell. When gold goes sideways but silver keeps running, that's ladder rotation. Gold doesn't need to fall. It just needs to pause. Silver takes the baton. Look back at 2010 to 2011. Gold ran first, hit 1400, then consolidated for months. Silver went from 18 to 49, while gold barely moved. The ladder was loaded. Right now, the gold-silver ratio at 78 is still elevated. Long-term reversion sits closer to 60. At current gold prices, that implies silver in the mid-40s. And here's what most people miss. Pauses are not reversals when the ladder is intact. If silver pulls back to 30 next week while premiums stay wide, that's not bearish. That's the ladder reloading. The next push targets 35 and higher. Circle that. Which brings us to risk, because it's not what most people think. Everyone's asking, should I buy? Wrong question. The real question is, which signal tells you this surge turns into a squeeze? Silver can rip 10% in a day. It can also dump 15% on one headline. The difference between a surge and a sustained squeeze comes down to one thing: physical availability. If premiums compress while price rises, that's speculative froth. Dangerous. If premiums widen while price rises, that's supply stress. Explosive. Right now, we're in the second scenario, but that can change fast, sometimes in 48 hours. So, here are the three paths from here. First, continuation. About a 40% probability. Premiums keep widening. Shanghai pulls harder. Registered inventories drop below 30 million ounces. Price pushes through 35, and volatility explodes. Physical holders and miners win. Shorts and overlevered paper traders get crushed. Second, digest. Roughly 45%. Price cools back to 30 or 31. Premiums stay elevated. Lease rates come down slightly but stay above 1%. This is actually the strongest setup. The ladder reloads and the next leg targets high 30s to 40. Third, shock. 15%. A dovish Fed pivot, a dollar dump, or sudden geopolitical calm. Paper silver drops 8 to 10% instantly. Physical premiums rise anyway because dealers refuse to sell at paper prices. Total disconnect. I'm not telling you which happens. I'm showing you what to watch. This week, keep your eye on 5 signals. First, 1-month silver lease rates. Normal is 0.3 to 0.8%. Stress starts above 2. Panic is above 4. We're at 2.8. If this hits 4, institutions are scrambling, and price usually follows within 72 hours. Second, retail premiums on Eagles and Maples. Normal is 8 to 12%. Tight is 15 to 20. A real squeeze is 25 plus. We're already around 18 to 22. At 25, physical decouples from paper and the game changes. Third, registered inventories. Comfortable is above 50 million ounces. Tight is 35 to 50. Critical is below 30. We're sitting near 34. Below 30, delivery stress becomes visible and shorts panic. Fourth, the gold-silver ratio. Above 80 is stretched. 70 to 80 is rotation. 60 to 70 is mean reversion. We're at 78. A break below 75 means the ladder is fully engaged and silver leads. Fifth, the Shanghai premium. Normal is 10 to 30 cents. Pulling is 50 cents to $1. Desperate is above $1.50. We're at $1.20. Above 150, China is stripping London vaults and supply stress goes global. This isn't advice, it's pattern recognition. Now, quick risk management because this matters. If you're trading, respect the volatility. Cut position sizes in half. This is not the time for heroes. If you're stacking, accept the pullbacks. 20% drawdowns are normal in silver bull runs. Stagger entries. Time beats timing. Keep liquidity. 30% dry powder minimum. Correlations can break. Silver and stocks can fall together. Don't assume hedges will save you. Define exits before entries. Know your stops and honor them. Patience pays more than precision. Let the pattern complete. This could reverse tomorrow or explode Monday. Timing is unknowable. Structure is not. And here's the final takeaway. If you understand the valve and the ladder, you're dangerous in the best way. You watch signals, not headlines. You react instead of chasing. You're the group that saw 2011 and 2020 forming before they went vertical. So here's your binary question. Are we digesting and reloading or going straight continuation? Vote now and see the crowd's bias. Share one premium data point from your area. Help build the map. Subscribe. These patterns don't wait. Final insight. The physical market is sending signals the paper market hasn't priced yet. When that gap closes, it's violent. In markets, violence means volatility, and volatility means opportunity. Watch the valve. Climb the ladder. Community data beats headlines. Patterns beat predictions. Position accordingly.